Many investors crave stability and predictable returns in their portfolios. Fixed deposits, they give you guaranteed returns but at the cost of liquidity. Bonds, they can also deliver steady returns but the risk and liquidity vary a lot more. So here's the big question. If you're aiming for diversification, do bonds really fit your risk appetite and financial goals? Today we are looking at one online bond platform called Altifi to see what it offers, who it might suit and the risk you should know about before you invest. So hi there, welcome back to Holistic Investment, where we simplify the world of personal finance for individual investors like you. So now before analyzing this bond platform, let us first understand what are bonds. So a bond is simply a loan you give to a borrower. It could be the government, a company or even a bank, and they promise to return your money with interest. But before you jump in, you need to ask, what if they default? What if interest rates change? And what if I need my money back before maturity? Government bonds are the safest, but they often can't beat inflation. Corporate bonds can offer higher returns, but the trade-off is higher risk. That's where credit ratings come in. Agencies like CRSIL, CARE and ICRA rate issuers from AAA, which is the safest, down to D, which is defaulted. But here's the truth. Ratings are helpful, not bulletproof. Remember ILNFS, DHFL, Yes Bank, 81 bonds? They were all rated before things went south. Another key detail is the type of bond. A senior secured bond gives you first claim on collateral if the issuer fails. Unsecured or subordinated bonds, you're way down the payment queue. And the perpetual bonds, they may never mature at all. So even if a bond is listed on a SEBI registered platform, the safety depends on the bond itself, not the website. There's credit risk, liquidity risk, and the temptation of flashy, high yield offers that may hide higher risk. So knowing all this, how do online platforms like Altifi actually fit into the picture? They don't remove the risk, they simply make bond buying more accessible. So the real safety still depends on what you buy, not where you buy it. So with that in mind, let's take a closer look at Altifi, how it works, the type of bonds it lists, and the things you should check before deciding whether any bond on it is right for you. So Altifi is a wholly owned subsidiary of Northern Arc Capital, and its brand itself as a retail debt platform that makes bond investing fully digital. So the interface is clean, mobile friendly, and gives you access to products like corporate bonds, government securities, commercial papers, NCD IPOs, treasury bills, fixed deposits, sovereign gold bonds, and securitized debt instruments. Sounds like a lot of choice, right? Well, here's the fine print. At the moment, most of these are just listed categories, not actively available. The main active segment right now is listed bonds. So interest can be paid monthly, quarterly, or semi-annually. Sounds flexible, right? But ask yourself, will you reinvest that interest or just let it sit? Because without reinvestment, compounding slows down. And yes, if the issuer's cash flow takes a hit, payments can be delayed or skipped entirely. With a minimum ticket size of just 10,000 rupees, the platform is open to almost anyone. But accessibility doesn't always mean suitability. If this money is your emergency fund, you might be better off in something more liquid. These products work best when they are a planned part of your portfolio, not a random add-on. Now, does using Altifi guarantee complete safety? No. Like other platforms, it complies with SEBI's framework, which helps protect against fraud and ensures operational discipline. But it doesn't eliminate default risk. The truth is, whether you use Altifi or any other platforms, you still need to analyze the issuer's financial health, understand the credit rating, and know that ratings can change. Assess the product's risk before investing. So the platform is a tool. The safety lies in what you buy, not where you buy it from. So Altifi is aimed at investors willing to explore non-traditional debt products for higher returns than fixed deposits or savings accounts. So it could suit investors comfortable with higher risk debt options, aggressive savers trying to beat FD rates, people with surplus capital, and a strong, safe core debt portfolio. But before you invest, ask yourself, am I ready to face the possibility of an issuer default? Can I hold until maturity even if I can't sell yearly? What happens if the platform platform changes its model or shuts down, does this product actually fit my broader financial strategy? Think of Altifi as a potential return boosting layer, not the foundation of your portfolio. So, one of the pro tip I can give you is only allocate here after you have built your emergency corpus and secured your core investments. And also, high returns often come with hidden costs, and in bonds, taxes are one of them. So, interest income from bonds, they are taxed at your slab rate. Capital gains taxed differently depending on whether they are listed or unlisted and whether they are short term or long term. So before chasing that extra 2 to 3% yield, ask yourself, will it even beat inflation after taxes? So bond platforms love saying better than FD, safer than equity. But here's the reality. Yes, equity funds can be volatile, but they rarely default. Markets tend to recover over time. Bonds, on the other hand, can deliver a permanent loss if the issuer defaults. We have seen it happen. DHFL, ILNFS, Yes Bank 81 bonds, investors lost crores. Even senior secured bonds can fail if collateral values drop or recovery drag on for years. So equity mutual funds, especially large cap or hybrid ones, offer diversification, liquidity, and SEBI-regulated fund management, giving them resilience in the long run. So remember April 2020? Franklin Templeton shut down 6 debt funds overnight, freezing 25,000 crores. And these weren't even failing funds. They had great past performance. But when the market froze, their illiquid debt holdings couldn't be sold. So if this could happen under a reputed AMC with SEBI oversight, imagine the risk when you're lending directly to lesser known companies through a bond platform. TrueCap Finance once promised over 13% returns backed by small business and gold loans. Sounds irresistible, right? But when defaults rose, credit ratings dropped, and liquidity dried up, the illusion shattered. By July 2025, TrueCap defaulted. High return, high risk. Credit risk is like an earthquake. Unpredictable but devastating. Smart investors don't just ask what's the return. They ask, can this survive a crisis? And often a well-diversified mutual fund portfolio managed by experienced professionals is far better equipped to handle those shocks. Here's the first thing you must understand. SEBI registration simply means the platform is a compliant intermediary. It does not mean your investment is risk-free. So the actual risk lies with the issuer of the bond, not the platform selling it. So while the interface might look modern, the reality is your money is still tied to the credit worthiness of the company borrowing it. So some of the big risk nobody talks about is, first of all, credit risk. So many of the high yield bonds listed online are lower rated. So the higher the promised return, the higher the risk of default or delayed payments. Are you being compensated enough for that risk? Next is liquidity risk. Some bonds are illiquid, meaning if you want to sell before maturity, you may not find a buyer. That's a risk mutual fund investors don't face because funds handle liquidity for you. Third, misleading yield focus. Platforms often highlight just the attractive interest rates, but do they equally highlight the possibility of loss? Not always. So what are the final takeaways, especially the key takeaways? SEBI registration is not equal to guaranteed safety. Bond platforms like Altifi, Bonds India are SEBI registered as intermediaries, not as guarantors of safe or high return products. And next, default or real are not rare. So cases like DHFL, ILNFS, Yes Bank 81 bonds, SREI Infra and Reliance Home Finance show the risk of blindly chasing yield. And next, don't be misled by user-friendly platforms. A sleek interface doesn't reduce risk. Always read the fine print and evaluate the issuer's financial health. So if you prefer safety, consider RBI Retail Direct. So for sovereign backed safety and zero platform fees, GSECs via RBI Retail Direct are an option. And liquidity concerns do matter. Many bonds have low trading volumes, making it hard to exist when needed. And also diversify, don't concentrate your investments. So for most investors, a diversified debt mutual fund or government bond exposure is safer than locking large sums in one company bond. So a certified financial planner, a CFP, can help you in these matters. So they can help build a debt allocation strategy tailored to your goals using regulated instruments like debt mutual fund, and help balance potential returns with real world safety and liquidity needs. And you can avoid emotional or marketing driven investment decisions. So in short, a few extra percentage points aren't worth losing your financial peace of mind. So if you do want a professional guidance in your investments, then get a free one-on-one consultation with our CFP by clicking the link in the description to book your free session today and create a safe goal-based investment plan that will work for you. And if you find this video valuable, give it a like, share and subscribe to our channel for more such financial insights.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.